In this presentation, we will work a problem related to future value in Excel. The information will be up top. We're going to enter that information into the blue area down below. We do recommend setting up the information in this format whenever working a problem, that being the information for the problem up top with the text in one cell, the numbers in another, so that we can refer to the numbers with cell references, that being the most efficient way to move forward. Remember that when we think about the future value, there's a couple of different ways that we can calculate the future value. You want to keep them all in mind. You want to keep them in mind to know that they're all the same thing. We're not talking about different animals, different things here. They're all going to be the same type of thing. Once you know that, it's a lot less intimidating to see these different functions and see people talking about these different things, because you'll know that they're all related, and you can use whatever method is best for you to go through and double check these things. So we'll take a look at a few of them here. The future value, of course, we could do with a formula. That's not what we'll be focusing in on here. Most of the time in practice and even in schools and in study, we don't often use the formula here. And when we go to the annuity, we typically don't really need the formula, although they could ask you to do it with the formula if they so choose. Oftentimes in study, there's going to be tables that are going to be asked to use. Tables are really useful because they allow us to use a simple calculator for school, and also not make us go through the calculations of the formula. So they're going to be similar to what we would do in practice, which of course would be Excel, but without Excel in essence. And then of course with Excel, we'll use Excel functions in order to do these types of calculations generally. So we want to know that they're all related. We want to have an idea, of course, what is happening as we go through these calculations. Data up top, periods, we're going to be 2. We're going to say they are 2 years. Remember that the years, it could be something other than years. In other words, we could be talking about months or something like that. Rate, 10%. Remember that the rate typically means the rate per year. So if it was a rate per some other time period, such as a month, we would have to take that 10% and divide it by 12 to get the coinciding rate to the number of periods. And then we have the amount, which is going to be the $200. That's going to be the amount that we are going to be using that is in today's dollars, that we're going to future value and see what it will be in future after 2 years time period at the 10% rate. There's often confusion about what the future value means and what this rate means here. So what we're talking about here is if we had $200 today, what would the same amount be worth if we didn't get that $200 in essence until 2 years from now? In other words, how much money would someone have to give us 2 years from now in order for it to be equivalent to today's money, the 200? There's a couple things in consideration here. One is just going to be the time value of money. So you might say, well, that should be the rate then, should be coinciding with the inflation rate, because 2 years from now, I'm going to be able to purchase less stuff, and therefore it should be somewhere with the inflation rate, which you would think would be normal times 3 to 5%. Or you can think of, well, I could invest my money right now, and the opportunity cost of what I could be investing in, the rate of return, is going to be the value of the money. So given that if I think I can make 10% on it, then the two years from now, you'd have to give me something that's worth basically the 10% higher for 2 years in order for it to be of equivalent value given my opportunity cost. So this rate, what we're talking about with this rate, could change depending on what our objective is, whether it be an investment type of discussion or just basically time value of money type of discussion. But in essence, we know that generally the dollars today are going to be worth more than dollars in the future. So the $200 today, if you weren't going to give me something until 2 years from now, you're going to have to give me more than $200 to equal the value that we could have gotten today with it. Okay, so given that in mind, we're going to use the table first. So using the table, we're just going to take the amount, which is going to be, of course, the $200. And then we're going to use the table on the right here to find the rate. Note we have the periods on the left, and then across the top, we've got the percentages. We're looking for 10%, and we're looking for 2 time periods. So we're looking at the 1.21. Note when we're considering the future value, it's going to have to be something that's going to be greater than 1, because if we're talking about how much money you would have to have in the future, it's got to be something higher than what we have today in order for them to be equivalent. If I get 200 or the equivalent of 200 2 years from now, it's going to have to be some amount in dollar terms that is higher than the amount today. So we're going to say, all right, here's going to be the rate. We're going to say this is going to be 1.21, and that'll give us our future value, which we're going to just multiply out as the 200 times the 2.21. And that's going to give us, if I reformat this cell into a proper formatting, the 242. We can do a similar calculation in Excel. A couple ways we could do it. Let's go with the formula box first. So we're going to go to the formulas up top. We're going to use the insert function. You can type in future value, and you're looking for the FV, future value. This is the one, description down below. If we select OK, we get the input box. So this is our function box or arguments that we could have, the function arguments. The rate is going to be the 10%, which is in cell B4. And then the number of payments, we're just going to go down to the number of periods. Number of periods is going to be 2. In our case, 2 years. Now again, if this was something other than years, like a month, you'd have to divide the rate by 12 because we want to get a monthly rate in that case. And then the number of payments are going to be 0. And this is the tricky factor because we're going to use the same function for both annuities as well as single sums. So therefore, we're going to have 0 in the payment so that we can use the same function. And we want to pick up what the present value is. Here's the present value, that what we have now, that we want a future value after a 2-year time period. So there's going to be our data. We're going to say, and here's the result, 242 looks correct. We're going to say OK. It has a negative. I usually flip the sign to get a positive number of this function by double clicking on it, going before the F and just putting a negative, which will in essence take that and multiply it times -1 to give us the 242. Now let's do the same calculation without the formula box, but just with a formula. So I'm going to delete this and do it again. We're going to say negative instead of equals, so we flip the sign, or you could put equals and it'll have a negative number. FV, future value. Double click the future value, and we're just going to follow our little instructions down here. First, they want the rate. So rate is going to be up top, 10%. Then we say comma to get to the next function. That's common Excel function. So then we're going to say number of periods. Number of periods up top is going to be 2. Number of periods is 2. And then we're just going to say comma to get to the next item. And this is going to be the payment amount. This is the tricky one. There is no payment amount because this is not an annuity. So we're going to say 0. That's the tricky piece. And then we need the present value up top. That's going to be the 200. And then we could just close this up, Shift 9 and enter. And there's our 242 once again. Okay, so we could go through kind of a check type of figure on this as well. This might help us to kind of solidify this in our minds. So if we say the check, if we say, okay, let's start off with the present value of the amount, let's just say the present, let's call it the present value, and we're going to say this is going to be the 200. And then we're just going to say the rate is equal to the 10%. And this is going to be after 1 year, then there's going to be an increase after 1 year of 200 times 10%. That's going to give us $20. So the amount then after 1 year, instead of 2 years, or the future value after 1 year would be equal to the 200 plus the 20. And then we had 2 years, so we're going to do this again. The rate is 10%. So the increase is going to be equal to the 220 times 10%, or the 22. So the amount at year 2 is going to be equal to the 220 plus the 22. And there's our 242. So there's just a kind of a calculation. You can see how this basically works out. If you do a check figure kind of calculation, it might help to get this stuff going in your mind. And now we're going to look at the goal seek, and we're going to use the function of goal seek. Now, remember that we're usually looking for the future value with this equation, and we basically want to memorize that function in Excel. But we could ask for something other than the future value. Now, if they ask for present value, we'll use the present value function. We should know that one. Those are the two we want to know. But they might ask us for like the rate, the interest rate, or the number of periods. And if we could figure that out in a formula by plugging everything else in, if we knew everything else but one variable, and then solving for it. And we could do that same kind of function in Excel and let Excel do the math for us. So that's what I would recommend doing here. So if they ask us for, say, the interest or the number of periods, and they give us all other data, which could happen in practice, we're going to say, all right, well, instead of me learning 3 different formulas in Excel, which I could do, we can look up 3 different, we could figure out, but we can learn the main 2, present value, future value, and that helps us with the annuities and the single sums, and then use something like a goal seek to basically figure out the other factors with regards to those formulas that they could ask. So here's scenario 1. If we want to know the rate, let's say we don't know the rate, but we do know what the future value should be. We know that the present value is 200. We know the future value is the 242. We need to know what the rate is. Well, I can say I have no idea what the rate is, but let's just plug in a rate, then use our present value, our future value formula, and then ask Excel to figure out the rate that will make the future value formula equivalent to what we know it should be, 242. So let's do that. We're going to say, okay, let's just choose a rate. Let's say, I don't know, 2%. 2% on the rate. And then we'll go down and we'll put in our future value formula, hoping to get 242, knowing we won't because we just guessed a rate out of nowhere. It's not going to be right. But we want to get the function in first. So we're going to say negative future value, double click the future value. It's going to be the rate, comma, the number of periods. And the number of periods should be 2, so I changed that, be aware. So 2, and then comma, and then the payment amount is 0, that's the tricky one, comma, and then the present value is 200. And then we're going to close this up. Again, we have all the information to get the future value, but that 2% is wrong. We just guessed. So we know the future value isn't going to come up to what it should be, 242. Instead, it's at 208. Now we want to change the rate until we get this number to 242. So I could say, well, what if it was 3%? It's closer. What if it was 4%? And we can basically ask Excel to do what I'm doing here until we get to this number to be what it should be, which is in essence the same as basically looking for the missing variable in a math equation. So we'll let Excel do that. To do that, and again, you can put your cursor anywhere to do the goal seek function. So we're going to go to then the goal seek in the data up top. We're in the forecast group. We're looking for what if analysis and then goal seek. Goal seek, that's the one. We're going to set this cell. So we're going to pick the cell that we want to set. We want to set this cell to be what we know it should be, 242. It should be that 242 by changing the one that we just guessed randomly, the 4%. So let's review this again. We're saying, hey, Excel, please set the cell B30. Please set that cell, that 216, to be what we know it should be, the 242. Do that by changing the related cell that is connected through formula, that being the interest rate. Just check all the interest rates you can until you find the one that makes that cell what we know it should be, 242. So we say, okay. And then it checks all the rates and it finds, okay, there it is, 10% happens to be it. That's the one. So that's a useful tool to use. It could be used in much more complicated formats as well. Let's do the same thing. Let's say we don't know the number of periods. So again, I know the rate and I know the present value. I know the future value too. It's 242, but I'm going to use a formula here to get the future value and then allow Excel to back into the number of periods. So I'm going to say, I don't know the number of periods. Let's say it's like 20. I have no idea. And then we'll put in the future value and say negative future value, double click the future value. The rate is 10%, comma. Number of periods, we said 20. We don't know. We're just going to say 20, comma. The payment is 0 because it's not an annuity, comma. And the present value is going to be 200. Now we're hoping this comes out to what we know the answer to be, 242. It won't because we just guessed 20 for the number of periods. So this is way off, right? And we can say, it's too high. What if I said 18 periods? Better. 17? And now I can basically say, hey, Excel, make that whatever it should be to make the future value right. Now, how do we do that? Goal seek. So we're going to go to the data up top. We're going to go to the forecast, what if analysis, goal seek. And we want to set this cell to be 242 by changing this cell. So again, once again, what are we saying? We're saying, hey, Excel, would you please make this cell be what we know it to be, 242? We want you to do that by changing the cell that we don't know until it makes it happen through the functions and formulas that we have entered, the present value or future value formula. Change that 17 to whatever you have to do. Do whatever you got to do to that 17. We'll say OK. It does what it has to do and changes it to 2. And that's, of course, what we would expect it to do.